Let's say you're analyzing a deal for a 100-unit apartment complex. The broker says it's still at 5% cap rate. What does that actually mean? Is it a great deal, or are you about to overpay for that apartment complex? Cap rates are one of the most talked about metrics in multifamily investing, but also one of the most misunderstood. By the end of this video, you will not only understand cap rates, you will know how to use them to make smarter investment decisions and avoid costly mistakes. In today's video, we'll define what cap rates are, discuss why they matter and how to use them effectively, explore factors that impact cap rates such as interest rates and treasury yields. Last but not least, break down the differences between the property cap rates and market cap rates. If you stick around until the end, I'll go over how to use this in practice. Hi, welcome to my YouTube channel. My name is Manny and I'm an engineer turned pharmacist turned multifamily investor. I'm a clinical pharmacist in Los Angeles, but also a multifamily underwriter for XSITE Capital and the founder of Microshift Analytica. In this channel, I talk about all things multifamily underwriting. What exactly are cap rates? Let's start with a textbook definition. The cap rate, or the capitalization rate, represents the annual return you can expect from a property if that property was paid for all in cash. The cap rate, or the capitalization rate, is estimated by taking the net operating income of the property divided by the property value. Let's take a look at this in an example. Say you have a 100-unit multifamily property that generates $500,000 in NOI annually, and the broker tells you it's on the market for $10 million. To calculate the cap rate, you take the $500,000 divided by the $10 million in value to get a 5% cap rate. But what exactly does that 5% represent? Is it the true return on investment on your capital invested? Is it the property's risk profile? Or is it something else entirely? I believe this is why cap rates is such a confusing metric, especially when it comes to new investors. Here's how I like to think about cap rates. I see cap rates more as a measure of market sentiment. Think of it like a thermostat. When cap rates go up, that's called cap rate expansion. You typically see this when the market sentiment is down and prices are falling. This is something we've seen in the past few months in the multifamily space. When cap rates go down, that's called cap rate compression. This typically occurs in a hot market with low interest rates, high investor demand, and rising property prices. Think of the period right after COVID, where we had the lowest interest rates, everybody was jumping in the market, and multifamily prices skyrocketed. But here's another way to think about cap rates. To quantify that sentiment, you can think of cap rates as a multiplier of your net operating income. At a 5% cap rate, every $1 of NOI, or your net operating income, is worth approximately $20 in value. In our example, with the $500,000 in NOI at a 5% cap rate, that equals $10 million in value. I prefer this perspectives over the return on investment definitions because cap rates are not a true return on investment. The cap rate only considers the value of the property. It doesn't look at other costs when it comes to acquisition, such as renovation costs, reserves, acquisition fees. For that reason, it's not a true return on investment when you factor in those additional costs. Another metric more powerful than cap rate is the yield on cost. That's something we can talk about in another video. Well, Manny, if you're saying cap rates are not a true return on investment, why do cap rates even matter? Cap rates matter because they're one of the simplest ways to gauge value and risk in a multifamily real estate investment deal. Let's say the treasury yield is currently 4% and a property offers a cap rate of 5%. That extra 1% spread represents your premium for taking on the risk of owning that real estate deal. Now, here's the key question. Is that 1% premium worth the risk? To answer that, you need to dig deeper into the property, the market, and your investment goals. Let's take a look at this from a historical perspective. If we look at the historical chart that compares the 10-year treasury, the orange line, and the cap rate, you can see that it's always a spread between the 10-year treasury, which is considered a risk-free investment, and cap rates for multifamily investment. This chart is showing the national average for multifamily cap rates since 1990 all the way to to 2022. From a multifamily investor perspective, you want that spread to be as wide as possible because that's what we talk about when we refer to that premium. Earlier, I talked about the 4% 10-year treasury yield and the 5% cap rate. That 1% or 100 basis points is your premium. For multifamily investors, we want this premium or yield to be as wide as possible. When that gap closes, the risk of investing in that multifamily deal increases because if you think about it from an investor perspective, why would you put your money in a real estate deal with the potential of losing that money when you can buy US treasuries, which are considered risk-free, and get a similar return? Multifamily investors are constantly looking at this spread or the premium to assess their risk if it's worth investing in that multifamily deal or purchasing US treasuries. If we look at another chart, this goes all the way to 2023, a similar comparison between the average cap rate and the 10-year treasury. You can see between 2022 and 2023, that gap between the cap rate and the 10-year treasury closed. That's why you saw a significant decrease in multifamily transactions. For most investors, it made more sense to buy US treasury, which are risk-free, versus investing in a multifamily deal. That premium or spread has closed significantly. Cap rates are incredibly useful when comparing like properties in the same market. That's key. A high cap rate might mean the property is in a riskier area or needs significant work, whereas a low cap rate often indicates the property is in a stable, desirable market with strong income potential. The location and the type of property matters. For example, a 6% cap rate in Los Angeles might indicate a lower quality property, but in Ohio, that same 6% cap rate could signal a high quality asset with lower risk. Context is key. Let's take a look at cap rates in the context of multifamily investments. I have 3 hypothetical properties. Let's say property 1, 2, and 3. And these are all Class C properties, 1978, 1985, and 1979. The first property is 198 units, the second property is 108 units, and the third property is 180 units. We received the financials for each of these properties. We looked at the T3 or the trailing 3, T12 net operating income for property 1 is 1.8 million, for property 2 is 1.75 million, and for the last property is 1.35 million. Let's assume all 3 properties are located in the same area. The market cap rates for Class C buildings in that area is currently 4.6. We talked to the broker and the whisper price for property 1 is 40 million, property 2 is 55 million, and property 3 is 32 million. On a price per unit, that's $202,000 for property 1, $348,000 for property 2, and $177,000 for property 3. Based on the whisper price and using the historical T3, T12, that translates for property 1 to a cap rate of 4.5%. Using the historical NOI, that gives you a 4.5% property cap rate for the first property, 3.18% for the second property, and 4.22% for the third property. Comparing the market cap rate to the property cap rate for each of these properties, you can see the delta. What does that tell you as an underwriter looking at these deals? From just preliminary analysis using the capitalization method to value these deals, you can immediately tell that property 2 is likely overvalued based on the current net operating income it's generating, because the market is telling you properties this type should be selling at a 4.6% cap rate. However, the seller is trying to sell this property for a 3-point cap rate. Cap rates are useful for coming up with a purchase price, but they're just one of several metrics. So you want to look at the deal as a whole. Remember, cap rates are just looking at the property at a snapshot in time. Looking at these properties at a snapshot in time and using their historical financials, using the cap rate valuation method, we can see that the estimated price for property 1 is 39 million versus the 40 million that the seller is willing to sell for. So it's not too far based on the historical financials. The second property is 38 million based on the NOI and the market cap rate. And the third property is $29.3 million. If we're looking at all of these deals, it's easy to see that property 2 is overvalued. Cap rate is just one of several metrics when looking at deals. You want to look at why the seller is trying to sell that property at a 3.18% cap rate when the market cap rate is 4.60. It could just be overpriced, or there could be a reason. But this is a quick way to help screen out deals that are overpriced. In the previous example, I mentioned property cap rates and market cap rates. So now let's dig a little bit deeper. Not all cap rates are created equal. It's important to understand the difference between market cap rates and property-specific cap rates. Market cap rates are averages across similar properties in specific area. They're great for gauging whether a deal is priced fairly, like we saw in the previous example. Property-specific cap rates take into account unique attributes like location, condition, and tenant quality for that specific property. When you're analyzing deals, you often hear terms like the T3 or the T12 cap rate, which is based on historical financials, the year 1 cap rate, which is based on your projected net operating income in the first year, and the exit cap rate or terminal cap rate. This is the expected cap rate at sale, which we use in underwriting to estimate the sale price for the property we're looking to purchase. For example, if the market cap rate is 6% and your property cap rate is 8%, it could signal an opportunity or a red flag. You need to investigate further to understand why there's a difference between the market and the property that you're looking to underwrite. Always remember, cap rates are one of many metrics we use when valuing multifamily properties. Let's take a look at how I think about cap rates when I'm analyzing deals in a real deal. This is a deal that I underwrote a few months ago. I wanted to show how I think about the market cap rate and the property cap rate, making sure that valuation is in line with what the market thinks and our estimated exit price is in line with where the market is heading. For this example, I'm using the MSA Analyzer. If you want a copy, you can visit www.msanalytica.com to learn more about the products that we offer. The seller was asking for $49.1 million. Going in market cap rate is at 5.4%. You can get this information from CoStar. If we look at CoStar, this is the property that we're looking at, Grove Park View. In the Analytics tab, if you scroll to the bottom, it shows you the historical chart of the market cap rate. You want to use this, also speak to the broker, speak to your property management company to make sure these values are in line with that market. If you look at Gwinnett County area, the current market cap rate is around this 5.3. At this specific point in time, the market is valuing Class C apartments in that area at a 5.3%. When you're doing your analysis, you want to make sure your going in cap rate is in line with the market, which in this case is around 5.3, 5.4, which is what we did for our analysis. For my analysis, the going in market cap rate, I said 5.4%. The cap rate expansion, think of it as your risk assessment for when you plan to exit deal. Because when underwriting these multifamily properties, where cap rates play a significant role is on exit. To estimate the exit price, which contributes the majority of the profit in most of these deals, you take the NOI at exit divided by what you estimate the cap rate to be at the time. The best way you can estimate the cap rate is by looking at where it is today and based on macroeconomic conditions, based on market sentiment, where you foresee that cap rate heading to. In a little while, I'll talk about some of the factors that impact cap rates that allows you to either compress or expand cap rates in your analysis. For our analysis, based on all the data that we have, we opted to keep the cap rates flat. Our assumption is going at a 5.4% cap rate, and we plan to exit at a 5.4% market cap rate. If we look at the pro forma looks at the historical financials. I looked at the T12 on the historical. I also compared the T1, T6, and I did the T3, T12. You can also change that if you wanted to. Let's say I do the T1, T12, because I like to look at expenses on a 12-month basis, and then the T3, T12. These are property-specific cap rates. On the T12, T12, that are 5.3. Remember, the market cap rate is around 5.3. If you look at the current market cap rate, we're around that 5.3 mark. you can see that the property cap rate aligns with the market cap rate based on the net operating income this property is currently generating. Now, if we look at it on a T1, T12 basis, the recent month of income annualized over 12 months of expenses is at a 5.6. So the 49.1 million is actually underpriced based on what the market thinks this property should be valued at. Now, if we look at the T3, T12 analysis, which is what most multifamily investors look at when they're analyzing these deals from a historical perspective, because income is more forward-looking. Rents today are significantly different from rents 12 months ago, so you want to look at the last 3 months annualized. The expenses are more seasonal, so you want to look at it on a 12-month basis. We look at the T3, T12, the property cap rate is at 5.47. If we look at the market cap rate of 5.3, this property is still valued below what the market thinks, just based on your historical financials. Once you do your expense adjusted cap rates, you go through your expenses, talk to your property manager, make the necessary adjustments, update the taxes, you see that the year zero cap rate is at 5.43%. Just comparing the market cap rate to the property cap rate, this property, based on the financials, aligns with the market. But that's just one metric. Once you talk to your property manager, put in your business plan, you go walk the property. If there are any renovations that you plan to complete, add that in there. You get a loan, see what the bank is going to charge you for the interest rate. Factor all of that into your deal. If we look at the annual operating statement for year one, you want to compare the cap rate. We talked about the T3, T12 cap rate. We talked about the year zero cap rate. We talked about the market cap rates. Now let's talk about our pro forma year one cap rate. How does that size up with the market cap rate? This is 1 year after taking over the property and implementing our business plan. 5.54% cap rate. It's still above what the market is, which is good because it means that you're buying that property at a discount using the capitalization method on a valuation basis. You still have to look at other risks, the interest rate. For this property, it's great because we're actually assuming a debt. The senior debt is at 4.4%. The supplemental debt is at a 6.04%. If you combine those two, it come up around 4.7. Looking at this deal as a whole, the market cap rate is at a 5.3%. Our historical cap rate for the T3, T12 is at a 5.47%. The year zero is at a 5.43. The debt at a 4.74%, so lower. We talked about that premium. As previously mentioned, cap rates only look at the property at a snapshot in time, and they only look at the value of the property. It doesn't take into consideration all the acquisition costs that you may incur in the process of trying to acquire this multifamily property. What I like to look at is the yield on cost, which looks at the NOI divided by your total cost that you're putting into that investment. Over time, you want that yield on cost to rise. The larger the premium between the market cap rate and the yield on cost, that's good because that's value that you're creating by implementing your business plan. This is an example of how I like to look at deals and how I use market cap rates and compare it to the property cap rate to see if what the broker is trying to sell that property for aligns with the financials and the income being generated at the property. Now that you understand how to apply cap rates, whether it's your property cap rate or your market cap rate, let's look at some of the factors that can impact the cap rate or this market sentiment that I talked about. It's important to note that cap rates do not exist in a vacuum. There are several factors that can potentially impact cap rates. The first one being interest rates. When the borrowing cost rises, investors often demand higher cap rates to offset those expenses, which can push property values down. This is what we're seeing in the multifamily space over the past few months and probably what's going to happen in the coming months. Next is the treasury yield. The 10-year treasury yield is a common benchmark. If treasury yield 4% and a multifamily property offers a 5% cap rate, think of cap rate as your theoretical return on investment, you need to decide if that extra 1% premium is worth the risk on taking on that investment. These relationships therefore mean that cap rates are not static. They're constantly shifting with the economy. Whether it's the interest rate, the market conditions, changes in the Fed, you have to keep a tab and understand where the market is going because that can potentially impact the market sentiment. If market sentiment changes, cap rates also changes. Remember, think of cap rates as a thermostat. They're not static. They're constantly changing with market sentiment. To wrap up, Here are key takeaways when thinking about cap rates and multifamily investments. Think of cap rates as a measure of market sentiment and a useful tool for comparing similar deals in the same location. Cap rates are not static. They're influenced by factors such as interest rates, treasury yields, and market conditions. Last but not least, use cap rates alongside other metrics such as cash on cash, internal rate of return, return on investment to get a fuller picture of the deal. Cap rates are not the end-all be-all. They are one of many tools to help you make smarter, more informed investment decisions. If this video helps simplify cap rates for you, smash that like button and share with someone who is trying to master multifamily investing. Don't forget to subscribe because the best deals go to investors who know their numbers. See you in the next video.